Good evening and welcome to tonight's member-only webinar where we look at ASX investment opportunities in review. As a reminder, if you would like to subscribe and join our investor club, you can do so by taking a free trial at investorsignals.com. Subscribe to the service for $47 per month. And if you'd like to know more about that, please don't hesitate to give me a call in the office tomorrow on 1300 614 002. The other products that we provide is research as a subscription service, brokerage account, and also managed funds. So you can find more information on all of those on the website. Moving straight into a graph of the US indices at the moment, we're seeing a rebound off the session lows in the early part of last week. And for the moment, what I've done here is, whilst we've got overhead resistance in the Nasdaq, the market seems to be sitting at a level where there could be a little further upside yet to go in this bounce back. So the S&P 500, sort of the main benchmark that we look at, we think about it from an average earnings per share. The results coming through at the moment support the valuations based on $240 of earnings per share for S&P 500. So whilst there's pockets of excess sort of valuation in particular in some of the tech stocks, broadly the US market's about fair value, but the risk is, what do the forward earnings look like 6 or 12 months out from now? Consensus earnings estimates have it growing roughly 10% over the next 12 months. In which case, which would support the S&P 500 trading up at about 6,000 points, roughly about 10% higher than where it is today. Obviously, any deterioration in earnings sees us back down at this level, which is about $225 of earnings per share, which ties into an index valuation of about 4,800. So when I look at the market at the moment, my assumption is that we're probably in for a period of more consolidation in US equity markets. It's hard to get this scenario where central banks, and we're seeing it in Europe and other developed economies now, start to talk about cutting interest rates. It's pretty hard to see that being necessary if economic growth continues to move at a level that would support earnings per share growing 10%. So I think where we're likely to end up is somewhere between this range, and think about the market as more likely to be consolidating, in which case it requires sort of, especially if you're on the trading side of the market, it requires you to sort of think about things like index hedging or inverse ETFs, where you can profit not only from a market rising but also from the market falling. If we have a look at the XJO, so again the rebound's been fairly strong off the lows last week. Overhead resistance, I wouldn't form a view that our market's really tearing higher and going to take out these levels. I think, just as the case is with those US indices, we could get a move higher of another 100, 150 points for our market, and then I suspect it probably runs into a little bit of a resistance there, and again just a function of probably the backdrop being one where the market more moves sideways than necessarily carrying on to create new highs. Having a look at what's gone on the advisory blog over the last week, so if you're joining for the first time as part of the public webinar, the advisory tab here captures what goes on the blog. This is really sort of a narrow selection from my perspective of where I think clients should be looking and thinking about opportunities. These are the ones that we're predominantly adding to our managed fund and or client portfolios. So I'll just move through what's gone on the advisory blog over the last week. If you'd like to get access to this on a daily basis, it's just a matter of going to the website, taking up that free trial, and ultimately subscribing for that $47 per month. So let's have a look. Cybersecurity, this is growing at above average earnings per share, so mostly nearing 20%. Certainly at a revenue level, 20 to 30% is about the standard for revenue growth within this sector, so certainly above average, and at an earnings level a little bit similar, around sort of 18 to 20% earnings per share growth. So the cybersecurity sector, I think being a buyer of this on any dip makes sense. The correction here from 12.50 down to 10.50, about a 20% correction, and the bug ETF is actually listed on the ASX, and it's one way of getting exposure to that sector. Oil remains a preferred commodity. Santos is our sort of number one pick for exposure to the oil and gas sector. Woodside is number two. We don't yet own Beach, but certainly following the sell-off there today, it'll come onto our radar. Just want to do a bit more research on the issues the company's facing on the cost side that's impacting the share price at the moment. In the case of Tabcorp, the correction here from 120 down to sort of 55, we think that that's maybe an opportunity. It's a bit more speculative, and you'd certainly want to run a stop loss below the pivot low, and we'll have a closer look at that chart in a moment. Iluka, again, bit of a value play here within the commodity space. The correction from 13 down to 573. One to have a think about. It certainly doesn't sit as a high allocation as far, it's a much smaller position within our managed fund, but being a buyer of it down here, starting to present some value there. Beach Energy, take a look at that. Heavy selling on the open this morning, so you want to just give it a day or two and just see where support develops, and I'll keep you updated when we enter that trade on the advisory blog. BHP, comfortable being a buyer of that. The correction from 55 down to 40. Iron ore's holding up at $100 a ton. You don't want to be too overweight, so sort of pick which one. But BHP, Rio, Fortescue, Mineral Resources. Out of those, our preference is really Rio and BHP, then Fortescue, and then Mineral Resources. But you certainly want to be keeping a close eye on these iron ore names following the recent selling that's occurred. ASX, so comfortable here. 3.5% dividend yield, fully franked. We think it continues to sort of hold up at sort of this higher low formation. You'd want to be a bit more cautious on that picture if you saw it break through that $60 level, and especially so if it broke through that $55 level. PEXA, this is an interesting technology play. We like the growth opportunities with them expanding into the UK. Again, you just need to be a bit cautious given the market backdrop. So you want to think about a stop loss there below sort of that 12.50, and especially so below that $11. But I quite like that, and we hold PEXA both in our property trust managed fund and also in our Class A Australian equity fund. International value ETFs, I think as interest rates maybe start to come back a little bit, some of these value opportunities here where we've seen a correction from $28 down to 24. So again, if you're trying to add international exposure to what's mostly a domestic Australian portfolio, the VanEck Vector International Value ETF is something you could have a look at. I've created a range there from 23 to 24, and you might want to think about accumulating a small amount of that within that range. AMP's really interesting story. It seems to be that they've found an inflection point. It's rallied from sort of 90 cents now up to $1.30. The underlying story here is earnings are growing at about 5%, but AMP's delivering on a number of new product fronts, which is likely to just keep driving, I think, investor interest in AMP. So, again, I would say, think about stop losses if you're going to jump into this position in your investor portfolio. On a reversal break back down through $1.10, you probably just want to jump out, have a stop loss and get out of it. But everything I see at the moment, AMP's earnings are likely to keep heading in the right direction. Moving back through the older articles, China large cap. So this is really just a deep value play here. The Chinese equity market has been uninvested in for good reasons, given sort of uncertainty around Chinese policy and other macro factors that are obviously impacting the Chinese economy. But the correction here from 70 now down to 35, so let's call it roughly 50% correction there. Look, big indices generally have a track record of not moving too much below that sort of 50% correction mark. Maybe .com bust. The Nasdaq, I think, was down sort of 65%. So that was a bit of an extreme. But mostly when you see large cap global indices selling off in this magnitude, ultimately you'll look back in a number of years and recognise it was pretty reasonable value. So look, it's not something that I think tears higher tomorrow or next week. But again, for your investor portfolio, if you're looking for value and it's something that you could see yourself holding for the next sort of 2 to 5 years. I think China large cap looks cheap. This is a new ETF that I'm yet to really kind of. I'll put more research on the advisory blog tomorrow around this. It's a new beta shares digital health and telemedicine ETF. So again, the correction from 11.50 down to 8.30. Put this one on my radar, and I'll put some more research up on that one tomorrow. Global semiconductors, look, it's expensive, and it's an area that obviously you just need to be a bit careful about, but you can't deny the underlying growth in these data centers, and AI is likely to just keep driving that demand. It's a valuation issue, not a demand issue at the moment, is the way that I see it. But the correction here from 20 down to 15, it meant that it pulled back into our valuation range that we highlighted. So if you want to look at exposure to this sector, the global semiconductors, the code on it's semi which is a global semiconductor ETF. You just want to have a think about putting a stop loss below the pivot low there. The last algorithm buy signals originally there were at around sort of $11, and then we've had another signal come in here. Ramsay Healthcare open really strong today. I'll have a look at that chart in a moment. China new economy, another way of just sort of getting exposure to that oversold Chinese equity theme. Global copper. Look, copper's had a pretty good rally over the last year or so, but what we're now finding is the pullback from $16 to $12 has it resting back on the resistance level, so the old resistance becomes new support. So we're assuming that around this $12 level buying interest starts to rebuild for that copper ETF. We'll have a closer look at that at the moment. On the US equities, the index trading side of it, so we've hedged portfolios, we've covered those shorts now. But we profited from that sell-off through being short S&P 500 and Nasdaq futures, micro mini futures. So if you'd like to talk to me about index trading, and my preference is certainly futures and exchange traded funds, but if you'd like to have a chat about that, please give me a call in the office tomorrow, and I can sort of walk you through sort of the thinking around hedging portfolios using index futures as my preference. But same with the XJO, we'd been on the short side of that and covered those shorts, and there we are back to last week's webinar. Alright, so let's jump in and have a closer look at these charts and analyse the opportunities in the ASX that you want to focus on at the moment. So Tabcorp, bullish on this, just simply need to run a stop loss below that low there at 54 cents, so a speculative position. Ramsay Healthcare, we think that although we're mindful that obviously they're carrying still a fair bit of debt against the Australian against their global portfolio, but they've refinanced the European side of their the hospital portfolios, and that may be a catalyst to see that spun off, which was ultimately what the acquirer of Ramsay, when they offered $80 a share for it, really wanted to see happen. So it's a slow process, but they've divested the Malaysian hospital assets. They've now, just in the past few weeks, completed the refinancing of the European hospital assets. Does that mean that they can now divest that that asset, and then does it set up a scenario where the Australian assets can be back on the radar for a potential acquirer to look at? That would be the most bullish scenario. In that environment, the stock's back up at $60-$70 fairly quickly. If we just look at sort of the earnings results that came out, I think it indicates that maybe Ramsay can grow earnings at 5-6%, and it also there were some signs that the inflationary cost pressures that were hitting the company were starting to abate a little. So where we're back at the moment, I think you'd say it's fair value. It's really looking for that inflection point. If we just study just this really simple guide there, the moving average, we can see the gradient of it still heading lower. So we haven't really hit that inflection point yet. So this is really some early analysis and asking the question, can this pivot low here of 43.43 hold, and then can this higher low here of 43.95 hold? The stock opened pretty strong today, traded up towards almost $46, but then closed on the session low. So you really need to see buying demand come in at around this 44.50 or something over the course of this week, and I'll keep you updated on the blog via the analysis there. So this is the cybersecurity ETF, correction from 12.50 down to 10.50. We've been adding that in a portfolio. The iPays, we don't mind this, certainly not as defensive as the cybersecurity ETF as far as really exposure to the economy goes, but the iPays is a really attractive growth area, and we've added some of that into our managed funds as well. The ASX defensive income contributor, as I mentioned earlier, just needs to hold that higher low there at $60.95. The value ETF, we touched on that one, so let's have a look at a bit more data here. So pre-COVID, trading up, sorry, in 2022 trading up at around $24. We've pulled back onto those highs at the moment. So the value range that I've got there from 23 to 24, but certainly start to think about being a buyer of it there. Slightly more defensive mix being obviously value plays rather than growth, and I think that makes sense at the moment in some areas of in particular US technology area. The growth stocks are still pretty pricey. Viva, not doing too much there at the moment. The global copper ETF, we looked at this one, corrected from $16 down to 12. That $12 levels there is the old resistance, so it broke out from that 12 prior to the rally. We're back at a level there. We could certainly start to have a think about that one. PEXA within the technology space, so we like the expansion into Europe. Just run a stop loss below that 12.55 there on PEXA. The global semiconductors from $20 down to 14, so we're buyers of that off that support level there. Depending on your strategy and your allocations, obviously just have a think about running your stop loss below that pivot low there at roughly $14. South 32, we've started adding a small amount of that into portfolios after switching from sell conditions to algorithm buy. The CNews, so the value story just stands out to me here when we look at the IZZ, which is the China large cap, or this one, the China new economy. So corrected from $10 down to $5. Still clearly downtrend. We're hunting for sort of a reversal, but the way we look at this is the pivot low there at 537 must hold, or 530 must hold, and even at the moment we're just watching this, waiting for a bit more buying support to create a higher low formation there at the moment. BHP, room for that in portfolio, so we hold that in our managed fund. Amcor, we've been bullish on this following the switch from sell conditions there into algorithm buy. Started to actually trim some of that position size here at $16. Rio, we've added that into portfolios. We think there's some value there. Iluka, a little bit sort of similar to South 32 as far as a position size allocation, so we don't have quite as much allocated to this as what we do BHP and Rio. But Iluka and South 32 start to sort of build in our portfolios at these levels. Beach, haven't bought this yet, but we'll certainly on the radar, as I mentioned, preference Santos, then Woodside. AMP, bullish on that off the back of new products growing revenue. It's already rallied from 90, but you can see the higher low structure there. Just be a little bit cautious if it traded back through 110. This is the one that's come onto my radar, and I'll dig a bit deeper onto this one and update some more facts on the advisory blog tomorrow. But the digital health and telemedicine looks interesting down here at 845. Block, again, you could either consider this as a direct stock opportunity, or think about the portfolio approach through the iPay ETF. And China large cap. So let's just have a quick look at this. So from $70, the peak was in 2021. We're now down at sort of moving off the $30 support, but roughly that 50% correction there that I spoke about. Not doing there in Blue Scope, and there we are back to Tabcorp. So let's just have a quick look, and I won't go through too many of these this evening, but let's just have a quick look at what's gone on in the investor portfolio. So some of the recent positions there that have dropped into the investor portfolio we've covered tonight. If we have a look at sort of some of the ETFs, we can go through here and see positions that have just dropped into the ASX iShares, the Vanguard model portfolio. Sorry, that one there is the Vanguard model portfolio. And now these are all investor models that we're looking at under here, so we tend to hold these positions for months and years. The new technology that we've added in here is the trade table, so short-term trading, 7 to 45 days. If we have a look at the ASX 200, so we see some new positions that have dropped in here today. So PEXA and NextDC have just been added today. Arena REIT was added 3 days ago, and so on. You can see here these all have tight stop losses in place, all below the pivot low. If we have a look at the performance of this over the last 18 months, it's done very well. Peaked at being positive 42%, currently still up 34.7%. So there's a couple of different ways. You can subscribe to the technology and place these trades yourself, or you can have a chat with me about getting access to the strategy via our managed fund. I look forward to continuing to share the analysis with you via the advisory blog, and I encourage you to jump onto the Investor Signals website, take advantage of the free trial. Join me on next Monday night and the following Monday night, and in the meantime you can keep up to date on a daily basis with the trades and investments that I'm updating on the advisory blog. And as always, if you've got any questions, any part of tonight's presentation that you'd like to talk to me about, please give me a call in the office tomorrow on 1300 614 002.